Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Netflix this morning, stock is down 7.5% pre-market after their Q3 earnings release, and the earnings themselves seem pretty good. There is a Brazilian tax impact that is hitting their earnings per share, so that's a miss. They did beat on the revenue side, and the market's reacting negatively. I think a lot of that is simply because Netflix is pretty aggressively priced. You're talking about a 50 PE ratio, 1.5% free cash flow yield. The stock is down pre-market, but in the past year, it's up 62%. In the past 5 years, it's up 154%. This has been a volatile stock for a little bit of time in the 21-22 range, was down as low as $180 in 22, now is trading above $1,000. So you've had a pretty good run if you're an investor at this time frame. I did own Netflix in the past, don't own it now, but would certainly be happy to own it again because this is a fantastic company that I think has a good long-term future. The question is, though, is it overvalued based on that future and where it's priced at today? And when you look at these earnings, you can't really complain about them. Top line growth is there, 17% in line with the forecast. The one thing that's hitting them is this operating margin miss of 28% below their guidance of 31.5%. A lot of that is due to a Brazilian tax issue. The operating income is impacted by a Brazilian tax matter, as they called it, a dispute with the Brazilian tax authorities that wasn't in their forecast. And a lot of this is due to a recent Supreme Court ruling over there in an unrelated case that's causing Netflix to reevaluate the situation and record an expense that they didn't think was going to be needed in Q3 2025. This isn't an expense for Q3 2025, it is an expense for 2022 through Q3 2025. And this is not an income tax, but it's really a gross tax on outbound payments that they have to pay. So if you think about the adjustments they're making, which I think is somewhere in the neighborhood of $600 million, that covers 2022 through Q3 2025. That means you're talking about ongoing costs in the $100 to $120 million range any given year, which isn't too bad from a going forward perspective. It is going to impact their expenses right now, but it's not going to be a thing that's going to be a deal breaker in the future for them. And that's also something they're going to still litigate with the Brazilian authorities. So if it comes to pass that they don't have to pay this outbound tax, then certainly that's a positive for them. But it's not the worst thing in the world, but you can see why the market is looking at it negatively given where Netflix is priced. What's going well for the company? Well, a lot of stuff. Engagement is there. They've had their highest ever quarterly view share in the US and the UK. Their ad business has more than doubled in 2025. They just had a selling season that is looking to show really good momentum going into 2026 on the ad side. And their advertising business is still a very small part of their business. So the fact that it's doubling off of 2024, it's off of a very, very small base. So I think that growth is going to be there for a while. In Q3, they had a bunch of good content out there. K-pop Demon Hunters was a pretty big hit. Everybody is singing it. And I think that's the thing with Netflix. They have a ton of content, and while a lot of it might not be the best thing in the world, there is a lot of it, and it appeals to a variety of different people. So some people may like The Diplomat, some people may like the K-pop Demon Hunters, some people may like whatever random boxing fight they have, and yet another person may like the WWE. And that's what leads Netflix to be the most popular streaming service. That's what allows them to raise prices more easily than some of the other streaming services. Because if you look at something like HBO Max, the quality of the content there is good, but you're talking about like one new show every other month or every month, whereas Netflix is weekly putting something new on there, whether it's their own produced content, something they're licensing, or something they're getting from other countries. And I think that's the beauty of Netflix. If you're a shareholder, I think that's why you hold it, because even though they've already grown quite a bit, I think there's still plenty of growth ahead. They have the potential to raise prices even further. The question, though, becomes how much is too much? I think we're getting to a spot with some of these streaming services where you're talking about high teens prices. I think HBO Max just raised their price to like $18.49 or whatever it is. That's getting a bit pricey for the average person, and these yearly $1, $2 increases are eventually going to cause some people to drop off. But as long as they're signing up new people, as long as they're producing content, I think at the end of the day, what that means is that people may not have 4 or 5 streaming services. If they do, they might just cut back to 1 or 2 or 3. And if it's one, I think Netflix is probably the clearest choice of the one to keep because it just has the most content. It's something you turn on every single day. And that's the nice thing about Netflix. This is a company that a lot of people are using and touching every single day, and they can certainly find more ways to monetize that than just the price of admission in terms of their subscription fee. There's obviously advertising. There's some of the game stuff they have. They've signed a partnership with Spotify for podcasts. And I think they're going to spill out into more avenues because anytime you have hundreds of millions of eyeballs on your product every single day or every other day, you can probably monetize that in some way. And again, talking about growth, this is a company that's continuing to grow. This is already a $45 billion a year revenue business, but it's still adding 17% of revenue growth in Q3 2025. That's accelerating from 15% last year. You're talking about 16% growth in Q4 24. They're guiding for 16.7 in Q4 25. So there's accelerating growth despite the fact that they're already so big. They're adding sports in the form of WWE, some sports fights. I think they have the Women's World Cup in 27 and 31, some NFL games. I was surprised they didn't participate in the F1 rights, but I guess they didn't find the value there. There is a lot of competition in this space, and I think that's one of the things that's really being talked about now, whether it's an M&A question for Netflix or other companies. What's going to happen to Warner Brothers Discovery? That's a stock that I own myself. I just thought the valuation at $8, I've made a couple of videos about that, made sense. Now that stock is trading at $21, and I think it's likely to be bought out in the coming months. So who's going to be the one that buys it out? There's been rumors around Netflix. There's been rumors around Paramount, which has already made offers. There's been rumors around Comcast, maybe Sony. I think Sony makes a lot of sense. Netflix maybe makes a little sense. Obviously, they would have to spin off the TV network business, the legacy media business. They don't want that. But then if you have Netflix and Max as separate streaming services, would they keep that? Would they have two separate streaming services if Netflix owned it? How would they buy it? Would it be through cash and debt or issuing shares? That'd be the interesting thing. I think the most likely buyer, in my mind, if it's not Paramount, it's either Sony, because they want an easy way to get into the streaming business, and Max gives them that, as well as the powerhouse that is Warner Brothers. I think they could spin off the legacy media stuff or sell that to, Verisent or whatever that spinoff from Comcast is, or Paramount, and then just keep the Warner Brothers division in-house, or maybe even Apple doing the same thing where they keep Warner Brothers, the production studios, and the streaming services, and they spin off the legacy media stuff. And I think Netflix, if they were to do that, would do the same, because nobody wants to deal with legacy media, but streaming is awesome. And that's why Netflix is valued where it is. I think the valuation is a bit excessive though, and let's look at that right now. You look at the valuation. Disclaimer: this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. So as you look at the valuation at $527 billion, about $8.5 billion in net debt leads to an enterprise value of $536 billion. Halfway there to $1 trillion. I think that's kind of expensive. I mean, I get why that's the case. It's Netflix. It's the best streaming service. It's growing in the mid-teens still, and likely going to continue to grow that way for a while, or at least that's what the market expects. But remember what happened in 22 and 23 when that growth slowed a little bit. That valuation just fell off a cliff. This was a $500 to $600 stock at that time. Basically fell, 60% to $200 pretty quickly, because the growth is baked in here. When you're talking about a 1.5% free cash flow yield, you need that mid-teens to low teens growth for a couple of years on top of improving margins to make the return make sense. And as you look at my expectations here, you can play around with the spreadsheet if you'd like. Hit file, make a copy. There will be a link to this file down below in the description. If you're new here, make sure to subscribe like the video, leave a comment, all of that good stuff. It helps the channel grow. I've got 16% growth in 25, which is what they guided to, with 20% margins, which is what they've guided to. Slightly slowing growth in the next couple of years, but still growing in the low teens and the high single digits. I think that's reasonable. There's still plenty of growth ahead for them. They only have about 10% viewing share in most markets, maybe 7 to 10% customer spend share in most markets. They've got a lot of good content coming out every single year. They've got hits like K-pop Demon Hunters, which they can monetize in different ways. They just signed a deal with Mattel and Hasbro for that. So I can see improving margins on the way as well. And even 24% might be a bit light. I think the majority of their money is going towards buybacks. I've got 80% of the $62 billion in free cash flow they're going to produce in the next couple of years going towards buybacks, offset by some stock-based compensation valuation still leads to about a almost 10% share reduction based on today's prices in the next 5 years or so. As I look at the valuation here, what's the right free cash flow yield to assess a company like this one? And from a valuation perspective, I think there's a couple of ways of looking at it. If you're a shareholder of Netflix, I think you look at this and say, well, we have got a $1,200 stock. It's trading at a 2% free cash flow yield. I think that's accurate. This is an amazing company. It's going to continue to growing. It's got so much potential ahead. I can see years and years and years of teens growth or high single digit growth with improving margins. I think it should be valued at 2% for a long, long time. If that's the case, even at 1241 before the market dump today, you're talking about a 10% return, a future price close to $2,000. Totally makes sense to buy it. Totally makes sense to hold it. But I think it's kind of an aggressive take. Stocks trading at 2% have to continually generate returns and continually grow. That's why the stock dropped from $500 to $600 to $200 in 2022, despite the fact that it was still growing, despite the fact that it was still generating a lot of free cash flow. That's because the market got overheated on this name and then kind of re-looked at it again, and it moved way too far in the opposite direction. That's why I bought it at 200. I've sold it since then, but I would like to own it again if it gets cheap enough. If that happens again, if it says, hey, this should be trading at a 3% free cash flow yield because maybe that's more reasonable for something like this. Maybe it's not going to grow at 16% forever, so I shouldn't assign it a 2% free cash flow yield. If that's the case, a 10% target return there gets you to an $850 price point, 30% off of the market price as of yesterday, which again, a big drop, but not impossible with names like this one that are trading at such hefty multiples that are based on very significant growth. I mean, this stock is down 7.5%. If that's still the case pre-market, you have a 7.5% off of a Brazilian tax assessment that is probably going to impact free cash flow and income by like $100 million a year going forward if it actually goes through. I mean, they're taking the full charge for 22 through 25 in Q3. But that's just, a one-time hit of that magnitude, and then it's going to become more reasonable for the next couple of years. So I think it's impacting margins in 25 more than it's going to impact margins in 26 and onward. So if it's moving 7.5% just from that, which I don't think is such a big deal at all, unless the market's worried about other countries doing something similar, it's only a Brazilian impact right now. What's going to happen if this thing suddenly grows 9% in 26 instead of 13% or 14%? Is that going to be a problem? I mean, it's possible that they guide for something even higher in 26. Again, they're raising prices. They're still growing pretty well. Their advertising business is booming. They're moving into other avenues. What else could they do? I think they can monetize it, like I said. Could I see gambling just embedded within Netflix in the future? Why not? You've got hundreds of millions of eyeballs. If you sign sports rights, why not embed some sort of gambling stream into those sports rights where you can gamble internally? Can they find other avenues of monetization? I think so. I think this is just the first step in Netflix's story, so I can see why 2% free cash flow yield can make sense for some people. But for me, I'd want something a bit cheaper. If it was in the $850 range, I would love that. If it was even cheaper, I would love that. Is it going to happen? I don't think so. I think it's more likely for the market to just remain frothy for a while. The stock could keep going up into the $1,300, $1,400, $1,500 range pretty easily as they release another successful quarterly earnings release. I mean, that's kind of the story I'm looking at here. But for me, it's just too expensive right now from a long-term return perspective. If I look at it this way, if I look at it from a 3% free cash flow yield on a long-term basis, and I look at what this is going to be priced at in 29 and 2030, I could see it being priced around the same level as being priced at today, despite the fact that the free cash flow has doubled, that the revenue has grown by 50%, just because the market looks at the forward picture a bit differently when it's potentially growing in the mid-single digits by 2030 and margins have stalled. So that's my take. Am I wrong? Potentially. I'm just a guy on the internet. Let me know what you think down below. I'm also interested to see what you think about who's going to buy WBD if you're a shareholder there. Is it Netflix? Is it Sony? Is it Apple, Paramount, Comcast? There's so many interested buyers that stock looks still very interesting to me, despite the fact that I'm up over 100 and something percent on it. Was glad I made those videos. Hopefully you enjoyed those as well and benefited from those. So let me know down below. Like the video, subscribe, all of that good stuff. And as always, thanks for watching. Bye.